Hello everyone, welcome to Thai Finance. Accounting systems are used to organize every transaction that a company can make. This helps to avoid mistakes in accounting and get a reliable ending balance of the company's financial position, so managers can make better decisions. Today we have softwares that can make the work for us, but we need to understand the basics so we get better results. Back in time, everything was done by hand. It was time-consuming and was easy to make mistakes. Today I will explain how transactions are recorded and how help us to check if the financial entry has been recorded correctly. Items in the balance sheet like cash, inventory, supply, and equity are separated into accounts called T accounts and can only go up or down. Transactions are recorded in a T account as debit or a credit. Nowadays, debit, DR, means just left, and credit, CR, means right. Left is an increase and right is a decrease. For example, let's take the asset account. For example, a company buys a machine, so it means that it has debited and it has increased, putting the cost of the machine. But this machine was credited with the cash account, so the cash account has to decrease. Remember, when I was talking about the balance sheet, we have a formula. Assets is equal to liabilities plus equity. Each of these can go up or down. So for every transaction, there must be a credit and a debit. Debit should always equal credits, and if these rules don't match, the numbers will not check the balancing system. So a mistake will pop up, and we can easily get rid of it. So credits should always equal debits. For every variable that goes up, another variable has to go down. For example, if you buy inventory, cash will go down and inventory will go up. So there's one is a credit and the other is a debit. Well, now, to wrap up, this template is a balance sheet. And in the balance sheet, there are several accounts and they are separated into groups. All the asset accounts will increase when you debit them and will decrease when you credit them. On the other hand, we have the liabilities and equity accounts. Examples of liabilities accounts are short-term debt, suppliers, and taxes. These will increase when you credit them and they will decrease when you debit them, as well as the equity. Owner's equity will increase when you credit them and will decrease when you debit them. And finally, we have the revenue and expenses accounts. And revenue accounts will increase when you credit them and will decrease when you debit them, as well as the expenses accounts. They will increase when you debit them and they will decrease when you credit them. So finally, you can make your accounting entries, but now you will avoid all the mistakes.